Today we're going to talk about something completely different from what we've seen so far. Okay, we're going to talk about financial markets. So we're going to talk about something specific on financial markets, which is structured notes. Very quickly, I'm going to start by describing what it is, because I believe that most of you do not know about it. We'll take a couple of examples to make sure that you do understand what we are talking about. And we'll finish by explaining the way we work together with 29K today and what we've done so far. So first, let's take a little step back to understand how do we invest today in a listed company. What do I mean by listed? Listed company is when the company is traded on an exchange, okay? And let's take an example that you might know. Let's talk about HDFC Bank, okay? Everybody's familiar with HDFC Bank. So it's trading on an exchange. So if you want to invest into HDFC Bank, you have basically two options. You can buy the stock, okay? And if you do so, it's because you believe that the stock price will go up. But what if you are wrong? Because you expose yourself to what we call volatility, which is the risk of owning a stock. You also have an uncertain income, which is a dividend. The dividend of the company is not something which is certain, because the company can decide to change its dividend, and there is no way you can do anything about it. And you also have a problem of market timing, because we are not Warren Buffett. So when we buy a stock, the entire market is not going to follow us. All right? So market timing is something which is very important. The other option that you have is to buy the bond. You're not looking for the increase in the value, but you're looking for the regular income stream that the bond is going to give you. But you have some drawback with bonds. The income is usually quite low, especially with interest rates in today's environment. You also have high minimums. To buy sometime one bond of a big company, it takes $250,000 to buy a bond. They also have long maturity. This means that it's a 5-year plus investment in most of the time when you buy bonds. And you also have the risk of rising rate, which is a bit technical, but just to tell you that when rates are rising, the price of your bond is actually going down. Okay, and most likely in today's environment, especially in euro, in sterling, in Swiss franc, in US dollars, the rates are very low, and most likely they're going to increase in the years coming. The third option is, as you can understand, the structured note. And I'm going to give you a very, very recent example. Actually, it took place 2 hours ago. I was with Shamshad at the entrance, and I look at her and say, "You have a beautiful dress. I would like the same for my wife." And she told me, "Listen, you have to buy the materials." I'm like, "No, I want to buy the dress." And she told me, "No, it's custom made." That's why it fits so well on her. Okay, so if I had to describe what is a structured note in one idea, one word, these are the words that I would be using. It's something which is customized, tailor-made. This is something that is created for one specific need. The need of the investor. What he's trying to do is what he's trying to achieve, is what we're going to deliver, creating the product. So basically, it is what you want it to be. This is something that doesn't exist until you express your need to create something. So now let's get into it. So what it is, it's a financial instrument aiming at investing into an underlying. And this underlying can be anything. It could be HDFC Bank stock, as we mentioned, could be the index S&P 500, could be an ETF, could be a commodity, could be gold, could be oil, could be a mutual fund, could be a currency, could be anything that is listed on the market. For today's presentation, we're going to focus on equity underlying, which is stocks, okay, for the sake of making it simple. If we could know what's going to happen in the future, we would not be here, we would be all rich, chilling on the beach, and the world would be different. But no one has a crystal ball, right? So there is no additional risk to disregard when you invest into a structured note. No human bias means that when you buy a mutual fund, you're putting your money into the asset management hands. You're putting your money into someone's hand that's going to take decision to manage the fund. However, into a structured note, there is no one controlling the product. The product is a written contract. Number 5, it's a truly tailor-made investment solution. And we have pronounced this word before in today's presentation. It's something which is trying to answer someone's needs. If you're trying to achieve something, we're going to try to understand and listen what you're trying to do, and to find a solution with the product that we are creating for you. What are the main benefits of the structured notes? We can create a regular income stream. And what I've heard so far today, it's what most investors are looking for, regular income stream. Number two, we always meet investor needs. As you have understood, we create a product for that. So there is no way we're going to miss what you're looking for, because this has been done because of your needs. And this is why the word solution makes sense. Number three, it's a better investment it's better than direct investment into the underlying. Let's take back the example of HDFC Bank. Okay, if you buy HDFC Bank, you have the full risk. The stock is going to behave the way it behaves on the market. With a structured note, we're going to be able to provide downside protection. We're going to be able to hedge the currency risk, which means if you want to invest into a company that is listed in euro, you don't have to hold euros. You can invest in US dollars. The currency hedge is embedded into the structured note. Number three, basket of underlyings. You can actually invest in several companies within one product. You can create a basket of companies and invest into one single structured note. Number four, access to certain markets. Let's take the example of oil and gold. If you want to invest in oil and gold, I'm talking about the real oil and gold. Not like, like a derivative or an instrument or an ETF, like the real price. You want to track the price exactly that it's behaving on the market. You can do that with a structured note without holding next to you a barrel of oil or a gold bar, which is quite expensive because you need insurance. It's very complicated to hold physical commodities. With a structured note, you can benefit from the performance of these commodities without holding them physically. Number five, bond or stock. Don't have to choose. You get the best of both worlds because we are combining the two instruments. And number six, quite important. It's an affordable solution because actually you do not need $1 million to create your own structured note. To give you an idea, we can try to create a product around $200,000 US dollars. But what if you don't have $200,000 to invest? Let's say you have 25,000. Let's say you have 50,000. Why don't we put several investors together that have similar needs and we can syndicate the product and create this product for you? So actually it's an affordable solution for something which is customized. However, there are things to keep in mind. I always like to talk about, we can call it risk, we can call it drawbacks, whatever you call it. You have to know how do we achieve this, because there is no magic. What I'm telling you since the beginning seems like a bit of magic, right? I can do everything I want, everything is perfect, I create everything for you, but where is the risk? When you buy a structured note, as I told you, the product is issued by a bank, by a financial institution, and we'll go after to the people we work with and how do we carefully select the people we work with. So what does this mean? This means that if the financial institution that issues the product goes bankrupt, you lose your investment. Let's say it's like the real estate market. If the real estate that you bought just like burned down, there is nothing else. You've lost your investment. So it's very important to carefully select the people we work with and the people who issue our structured note. Number two, secondary market. There is liquidity. These products are liquid. Daily, if you want to sell them back, you can. However, like many other investments, there's most likely going to be a loss because these products are designed until a certain maturity. That's why, together with Prashant, we try to keep it short. Most of the investment that we do are 2 to 3 years maximum, and we can go up to 5 years when we are looking for full principal protection. And I'll explain this a bit later in the presentation. But these investments are liquid. Okay, you might incur a loss if you sell them too quickly, but they are liquid. This is why we call them buy and hold strategy. When you design your product at the beginning, you say, this is how much I'm going to achieve. This is my protection where I feel comfortable with, but this is my time horizon, which means I'm committed to invest this money up to 2 or 3 years. Again, if you need it before, you can, but this has been designed to stay at least until maturity. Growth or income. The good news is that you can choose, because again, it's created for you. Are you looking for an income stream or are you looking for growth? Because when you buy a stock, if you're certain of what you're buying, you might be looking for growth as well. And then we can also add downside protection and currency hedge. So we will take two different examples for you to understand why do you need to choose and what benefits are from each version. So now let's try to make some wishes. What if we could make Amazon pay a dividend? Everybody talked about Amazon. I think Prashant mentioned Amazon. I think there was the Amazon name in the Hangout presentation. Everybody knows Amazon, right? It's a giant. It's one of the largest companies in the world. But it doesn't pay a dividend. Too bad. What are you going to do? So when you buy Amazon, if it goes up, good for you. If it goes down, bad for you. But in any case, you have zero income. It doesn't pay a dividend. With a structure note, we're going to be able to make Amazon pay a dividend. And I'm not going to be sitting on the board with Jeff Bezos. I'm just going to create a product. How about HDFC? How much do you get if you buy HDFC Bank and the stock doesn't move at all? 0.66%. Honestly, doesn't look really good. For the risk you take, the income that you get is very low. How about if we can enhance this dividend? Same thing, without to be sitting on the board. We stay here, we create the product together. What if we could fix the income for the investment period? What does this mean? As I told you, a company can decide to change and to reduce its dividend, and they are not going to ask for your opinion. What about General Electric? 2 or 3 years ago, this company was yielding around 5+% dividend, what we call a very good income stock. General Electric is going into a very complicated and tough situation in the US. I'm not getting into detail. Today, the dividend is below 1%. But this is not what you expected when you bought the stock. So with the structure note, we're going to be able to fix the income for the investment period. Number 3, what about securing your investment? What about if the underlying HDFC Bank, for example, falls 25% in 1 year? Can we give back to you 100% of your investment? Yes, because of the downside protection. Then we'll see what happens if it goes below 25%. We'll see that in the example. And last thing, what if we could include an insurance within the product? Which means, in case you've missed a monthly income, you have a chance to get it back. It's not lost forever. We can include an insurance within the product. All right, let's take example. I believe it's going to be much clearer for everybody after. Let's talk about Amazon once again. You know, Amazon is still the #1 subject discussed. You want to invest into Amazon. Again, 2 options. You buy the stock, okay, it's volatile, and you have 0 income. You want to buy the bond, okay, but it's going to be a long-term investment, and believe me, the coupon is pretty low. I believe Amazon bond pays around like 2-something%, 2 and 2-ish. Let's create a structure note linked to Amazon stock. 1-year investment in US dollars. In this case, there is no currency hedge because Amazon trades in US dollars as well. 25% downside protection, monthly income, and a guaranteed coupon of 6%. Okay, these are the criteria that you could be giving to your financial advisor. I'm looking to invest over 1 year. I'm very comfortable with Amazon. I'm fine with a 6% return. I believe it's a decent return, not too risky, not too conservative. And I believe that 25% downside protection is sufficient with Amazon. You know, the company can see some problems in his daily business, but I think that 25% is a good protection. Now I'm going to go a bit further, and I'm going to try to get ladies' attention. Being a French people, I had to talk about, you know, the French pride, which is Louis Vuitton. The CEO is actually one of the wealthiest men in the country. So, you know, ladies, you might want to buy a Louis Vuitton bag, or you might have a Louis Vuitton bag. But you can also say that the company, you know, is well run, and that's the case. And you might want to invest into the company. Because, you know, when you buy something from one company, you can also be associated with the company buying a stock. Okay, so same thing. You want to invest into Louis Vuitton. Fine, you can buy the stock. It's volatile. Less than Amazon, but it's volatile, and it pays a 1.8% dividend. Okay, Not super excited, but at least it pays you something for the risk you take. You can buy the bond, but in this case it's even worse because it trades in euro and the rates in euro are so low that if you get 1 plus something percent, this is the maximum that you're going to get for a 5+ year investment into the bond. Now we're going to create a structure note linked to Amazon. Same example to make it simple. 1 year, US dollars. First question. This is where the currency hedge is. You invest in US dollars in a euro listed company. And there is no risk for you on what is the US euro dollar Forex doing. No impact for you. It's neutralized within the note. Same thing, 25% downside protection. You feel comfortable that the company is well run. Monthly income, and you will notice that the coupon is slightly below. Why? Because the company is less risky. That's also why it pays less coupon. However, you can notice that it's almost 3 times the dividend. So you do not benefit from the upside on Amazon, on Louis Vuitton, but you get a good return versus what the stock is giving to you. Let's try to explain what exactly is happening when the note is launched. So these are 12 months. Okay, so this is the time horizon of the investment. Every month, you get the income. Okay, the stock is moving on the market. The price of the note is moving as well. But if you hold it until maturity, this example ends within the protection zone between 0 and minus 25, as we've seen. So because the stock ends within this protection zone, you're not going to incur the loss of 12%. You're going to get back 100% of your investment. The protection did its job. It protected your investment. Okay? So this is exactly why you invest into a structured note, because you get this downside protection. You invest over a short period of time, and you get your return versus a loss that you would have had investing into the stock. Now, the question is, what happens if it goes below the protection? I cannot really call this a good news, but it depends the way we look at it. Same thing, same product, but this time Louis Vuitton is going to go below the protection barrier and it's going to incur a 28% loss at maturity. What happens if you have the stock in your portfolio? You've lost 28%. The exact same Louis Vuitton, but in a structured note. You lose as well 28%, but you get the coupon, 6%. So your loss is actually only 22%. Again, this is not a good news to lose 22%. What I'm saying here is you're always better off with a structured note than with a direct investment into underlying, as long as you keep the product until maturity. This is why we design the investment period with you at the beginning. Because, let's take the previous example. Let's say you have the stock in your portfolio and it goes down below 30% and you're like, okay, I cannot hold it anymore. 30% is too much for me. And you sell. You make a very, very bad choice. This is why, the duration of the product is something very important, and that we try to keep it short without keeping it too short, because we are not trading. This is not stock trading. This is investment. And that's the big, big difference. Let's try to combine all these things and to make another example. Let's make an Indian basket structure. And let's take these 4 well-known companies by, I believe, all of you. HDFC Bank, Tata Motors, ICC Bank, and Infosys. These are the underlyings. And these are actually the dividends, again, the income that each stock is giving you when you hold them. 0.66 for HDFC, 0 for Tata Motors, 0.44 for ICC Bank, and 4.48 for Infosys, which makes an average of 1.4%. So you hold these 4 stocks and you have the full risk, right? The market is moving. If they go up, again, you're making money, no question. We'll take another example after that. The market doesn't move, you make only 1.4% for the risk you're taking. Let's make a structure note with these 4 companies in the same product. 2 years investment, US dollars, 35% downside protection and conditional coupon. I'll get back to that as well. Monthly income, 10% conditional coupon per annum with the memory effect. the famous memory effect that I told you about. In this product, let's say one of the stock goes below 35% for 1 month. You will not get the coupon. But if the stock bounces back above this 35%, you will get all the previous coupon that you've missed. And this is the memory effect. This is the insurance that the product is providing you. If the market goes down and you've missed 1, 2, 3 months, 4 months in a row the coupon, the 5 months, if the stock bounces back above, you'll get all the 5 coupons that you've missed. And this is the insurance that is embedded into the structure note. Now, as we've said, some people are looking for income, but we might have people looking for growth. They want to make a bet, they are sure that the stock or the underlying is going to go up, and they don't care about the income. As I told you, we can invest slightly longer when we're trying to increase the protection. Let's go for 100% principal protected note. What does this mean? This means that we have completely removed the downside risk. Even if the underlying goes down 100%, and listen to my words, I'm not lying, there is no magic. Again, when there is magic in finance, do not invest. It's a scam. Okay? I'm saying if the underlying goes down 100%, your principal will not be hurt. You will get back 100% of your investment. The only risk that you're taking with this type of product, again, as you remember, is the risk of the credit risk of the financial institution that we've selected. And I'll get back to that after, Axel. So let's take a mutual fund, just to make a different example. A BlackRock mutual fund, a Vanguard mutual fund, PIMCO, Fidelity, whatever, you name it. 4 years, we extend a bit the maturity because we're going to be able to benefit from the 100% principal protection. US dollar investment, no income. In this case, the investor is looking for growth. He doesn't need the income. Maybe he's having income on real estate. Maybe he's having income on different things. On this investment, he's not looking for income. But the beauty of it is like he's going to be invested in the same fund and he's going to benefit from 100% upside participation. No cap. So basically, this is what I call, in today's environment, not trying to be too technical, but because of the rates in US dollars, this is what I call a no-brainer. If you do have one of these funds in your portfolio, why don't you sell, let's say, 50% of the position? You keep the fully liquid portion in your portfolio with the direct investment and the downside risk, and you take the other 50% and you invest into this product where you have zero downside risk. If the fund goes down 20%, no impact. If the fund goes up 13%, you get 13%. Doesn't make any difference. However, you've committed your money for 4 years. So as I told you, if you want to exit before, it's possible. There is daily liquidity. But most likely you might incur a loss because this product has been designed so you're benefiting from the rates that the investment bank is giving you through this structure note for 4 years. So as you can see, it's fully customizable. We've talked about a French company, a US company. We've talked about income. We've talked about growth. I could be a running example for like my life because there is no limit. Everything is customized. Everything based on what you're looking for. What are your needs? What are you trying to achieve? So now the question is, how do we work together? What do we do with Prashant when we put a structure note together? We'll always start from the investor needs, from your needs. It's when you meet your financial advisors that you're going to tell them what you're looking for. And he should have this exact same discussion with you. What is your expected return? How much downside protection you feel comfortable with? And this very simple question, without knowing it, you're actually designing your own product. Like you go to the tailor. You step up, the guy takes your measures, and he's doing something which is customized for you. And this is possible with finance as well. So we list all the wishes, your wishes. We start from the blank page. You take a paper, you take a pen, and you start taking all the wishes of the client. 2 years, 35% downside protection, ideally double-digit coupon, 10 plus something coupon, and looking to invest into well-known companies. And this is very important as well. So then, how do we select the underlyings? Unless you come to your advisor and you say, I want to invest into the tech sector in the US because I believe in the Amazon of the world, the Facebook of the world, and the Google of the world. Unless you have your precise opinion because you like this company, because you've heard this company, because your friend have invested into these companies. Otherwise, we do it ourselves. But we do not pretend to be better than hundreds of thousands of analysts around the world. So what we do is we basically combine all the research that we have access to from very well-known investment institutions, and we screen them. So we screen more than like 2.5, around 3,000 stocks worldwide, and we apply filters. The first filter that we're going to apply is the market capitalization, minimum of 10 billions. Because we don't want to invest into small companies. When you do invest into a small company, it's because you know the company, you know something, or you trust something, or someone told you something, which is called insider trading, or whatever. So we don't want to be better than people whose job is to analyze companies. So we apply several filters. 10 billion minimum market capitalization, which means there is no way we're going to invest into a company that you don't know. 10 billion is a serious market capitalization. It can go much higher, but it's already like a good base. Volatility. We tend to avoid very volatile companies because volatility means risk. And what we're trying to do here is investing, not trading. We also look at what is the opinion of these research houses. We select only stocks where when we have almost a minimum of 75% of these analysts having a positive outlook on the stock. It does not mean that the stock cannot go down. It means that they have a positive outlook on the stocks over the period of time that we're going to select together. And we need at least 10 research houses to analyze the stock. Because if you have only one guy, okay, saying, oh, I'm very positive on this stock, but no one else is looking at it, it makes 100% positive outlook. But the guy is alone. What if he's wrong? So that's why we apply all these filters to make a very careful selection process on the company that we are investing in. And when you'll see the next slide, it will be just like crystal clear. Number 4, structuring, and that's my job. That's what I do. That's what we do together with Prashant. We look for the best combination. So this could be a very complicated subject, so I'm not going to get into that, but this product is created using financial models, mathematical models to combine options and to create this product. So we look at what's doable. I have the wish list. The client wants minimum of 35% downside protection. He's looking to invest, like 300,000, and he's looking for double-digit coupon, 10 plus something. Playing with the numbers, trying to make the selection process working. And I get back to Prashant and I'm like, okay, for 2 years, I get a coupon around, let's say 9.2. And Prashant told me, no, that's not going to work. The investor really needs 10+%. I say, okay, is he firm on the 2 years or can he go 3 years out? He said, no, 3 years is fine for this investor, but he wants double-digit coupon. So we're going to go back and forth. We're going to fine-tune the product together, running the financial models, and we're going to try to find the exact product that the investor is looking for. Once we have that, once we have the basket, let's say the Indian basket that we've seen, once we have the length, 3 years, the protection, the coupon, it's not enough because this is just indicative. This is the criteria that you've selected with your financial advisor. Then what we do is the best part. We're going to work with several financial institutions that we select together with Prashant, making sure that they are sound and well-run financial institutions and that we are comfortable with the name, and we're going to put all of them in competition. So we're going to send them the exact same criteria, and we're going to say, okay, show us what is your best price for this product. And each bank around the world, I'll show you a map with all the banks we work with, they're going to run their financial models, and they're going to show us our best price. Why do we do that? Because this is called first best execution, and this is something that we provide through Prashant to you, the best execution, comparing pricings like you do in your daily life. If you want to buy an insurance tomorrow, most likely you're going to go on Google or you're going to call a broker, someone that's going to put people in competition. Otherwise, you're paying a price which is too high. You're trying to reduce the margin of the manufacturer. So that's what we do. We send them the wish list, and they come back, no, not the wish list, the list of criteria, sorry. And they come back with their price. And I'm going to get back to Prashant and say, okay, this bank is showing this level, this bank is showing this level. Maybe Credit Suisse is showing us a coupon at 10.4. and maybe we have Barclays showing us a coupon at 10.8. It does not mean that you have to select Barclays. Maybe you don't feel comfortable with Barclays because of the Brexit, whatever. It's your choice. You don't have to justify yourself. But you feel comfortable with Credit Suisse, and Credit Suisse is offering 10.4% coupon. So we'll make a deal, and we issue the note with Credit Suisse because we think that the financial situation of Credit Suisse is comfortable for the next 2 years or 3 years, which is the length of our investment. Should I say something? Okay. These are 10 billion plus companies. You might not know all of them, but I can bet on 90%. These are not logos for the sake of being logos, right? These are the exact same company that we have invested in with Prussians since we started the business together. Do I need to name them? I mean, the tech company, obviously, the Amazon, the Apple of the world, the Google, Cisco, the Salesforce, even the Chinese company, Alibaba, which is an amazing retail platform, the banks, Bank of America, JP Morgan, some European companies, Shell, Enel, Airbus, the famous Louis Vuitton, some automobile, Volkswagen, McDonald's, Delta. I mean, some companies that you do use on your daily life. Not all of them, obviously, but companies that you know. Again, it does not mean that this company cannot go down. It doesn't mean that this company are going to be forever. But what we say is like we are comfortable with this company over the period of time that we design together. Again, I could say nothing or a lot of things. These are just the companies. Like what we do invest into. It's not like a random company like in the middle of nowhere, south of France, middle of Asia. Like no, we don't do that. Some people make a lot of money with these companies. Some people lost all their wealth making bets. It's not trading. It's about investing. And these are all the financial institutions that we work with, which means these are potentially all the financial banks that we can issue product with. It's actually very interesting because first, it's a lot. I don't know what you feel about, but I'm telling you, it's quite a lot of options. And also, we can adjust the strategy. Let me take one example. I don't know if many of you are aware of what's going on in Brazil today. Brazil is going through a complicated situation. Time might have been worse in the past, but it's facing challenging with the future new president and all the things that are going on in Brazil. So most likely, we're not going to select a Brazilian bank for our notes because currently, this is not a safe investment. We are completely fine, I believe, with the US banks. We are completely fine with most of them at that time for the period of time we invest. But most likely, we might not go for a Chinese bank, Haitong. First, maybe because you may not know it. And also, because we might say, okay, we want to avoid this like Trump-China trade war. Okay, as you notice, we have a lot of French banks. This is not because I'm French. This is just because French people have created the structured note. So they have an expertise in this, okay? And again, these are safe, sound financial institutions. Something which is important to mention. Some of you might say, but what about Lehman Brothers? Was Lehman Brothers a safe financial institution? The obvious answer is no. However, at this time, people were not really paying attention to what's going on at Lehman Brothers. Lehman Brothers structured note at that time, because it did exist 10 years ago, it was created most likely around 20 plus years ago, was offering very aggressive conditions. And this doesn't smell good. Back to my example, when we send out all the criteria that you're looking for to all the banks, if one bank is offering 17% coupon, when all the banks are offering around 10 plus something % coupon, there is a reason. No magic in finance, magic, do not invest. Okay? So, okay, people were greedy because, we have to be honest, no one really knew what was the credit crisis and what could happen to Lehman Brothers. Today, our feeling is that there is a risk. There is always a risk. You cannot say there is. If you say there is no risk, you're basically lying to your investors. However, we feel that these banks belong to what we call the too big to fail. These are systemic banks, which means a state, and believe me, will think twice, at least twice, before letting one of these banks go down. because the consequences are horrible. But no one knew before Lehman Brothers. Some like small little banks, went bankrupt, but a big bank like Lehman Brothers never went bankrupt. And to give you one example, it took more than 10 years, for example, for the French index on the French market to recover from 2008. We've breached the level a couple of months ago. 10 years just to recover from the loss of 2008. So believe me, I personally, and I cannot make a promise about it, but a state will definitely think twice about letting one of the banks go down. And you can see that happening. In Italy, many banks are facing challenges, and the state is putting down money. Deutsche Bank is actually facing challenges, a lot of challenges. I would be curious to know what the German government is going to do. A lot of people are talking about a merger between Commerzbank and Deutsche Bank. But again, the number one bank of the number one economy in Europe, most likely we're going to be facing some kind of like intervention from the state, trying not to let this bank go down. I'm not saying that there is no risk. I'm saying that it's an acceptable risk over the period of time that we invest into for these banks. Let's try to sum up. So why should you, considering investing into structured notes? Because again, it's a tailor-made investment, which means it's answering your needs because you have decided what it's going to be. And you can also manage the risk reward. We've seen some examples, but what if you want to have 7% coupon on Amazon? Fine, it's always possible. We're just going to reduce the downside protection. But now, do you feel comfortable with 20% downside protection on Amazon? Maybe not. Everything is customizable, so it's just a question of risk reward. The regular income stream. Again, the advantage is that we can fix the income for the investment period. You don't have the risk like you have holding a stock about the dividend. There is no uncertainty to this regard. Better than direct investment into the underlying. I believe we've talked about it a lot. Downside protection, currency risk, everything is there as long as you are comfortable with the time horizon. Acceptable financial credit risk in today's world, that's what I've mentioned. Again, I wouldn't do a structured note for 10 years on any of the banks. I'm saying any of the banks. Because 10 years is where you get to the unknown world. Everything can happen in 10 years. It's a very different time horizon than a 2 to 3 years investment. Diversify the portfolio and optimize the asset allocation. Again, as I said, you might have an existing position. Think about it twice. What could be the benefit of selling a portion of this position and investing into a structured note that's going to give you additional feature, the downside protection, the income? Invest even when there is uncertainty. And I'm glad Prashant showed this word and this sentence about Warren Buffett. This is exactly what happens. When you invest into a stock, let's say the market is very shaky, there is a lot of uncertainty. Would you buy the stock? Most likely no, because there is uncertainty and you have to have a good market timing. And unless I'm wrong, no one is Warren Buffett here, so you don't control the market, even if it does not either, right? But the market timing is very important. However, when you do buy a structured note, regardless of the time when you invest in, you have this downside protection. So if you really think about it, it even makes more sense to buy a structured note when the market is not at the peak, because if the market already went down 5 to 10%, which is the case as we speak, you have another 20 to 25 to 35, depending on what you're looking for, downside protection on the market. So when you cannot buy a stock because the market is too shaky, it's also a good idea to consider the structured note because it might be a solution for you to keep investing, not to stay with your cash, and keep getting income with this investment. I want to say thank you. I want to say that it could be a million question or 0 question. Again, you can digest this kind of thing that can be very new. What I just wanted to convey the message is that this type of investment is today offering to you through the association that you have with Prashant. This is something which is very customized, very tailor-made. And again, you can already think about it, and during your next meeting with your financial advisor, you can start talking about it. What are my desires? What am I trying to achieve? How much income do I want? How much protection do I feel comfortable with? So you can start even investing your way on what you want, the way you've decided. And this is because you're also associated with 29K that offers you this opportunity. Thank you very much.